Hello, I hope everyone is well. Given recent market volatility, I thought I'd spend about 5 or 6 minutes discussing risk tolerance and historical risk and return in the context of your overall financial plan. I'll also share 6 tips for the current environment, as well as ideas to build tax-free income now and in retirement. For those that don't know me, my name is Louis Green. I'm a certified financial planner, a chartered financial analyst, and a certified private wealth advisor with 25 years of experience, having seen many different market environments. I'm also author of the book 5 Steps to Retirement Planning. Here's the agenda for the presentation. Please note we do not provide legal or tax advice. Here's some information about my practice. My practice sits between financial planning and investment management. I believe that a comprehensive financial plan is the key to managing wealth. Growing up, I was inspired by my father, who was an accountant. Watching the value he provided to friends and family inspired me to pursue a career in wealth management and to do a lot of work on the tax side with my clients. Now, let's spend some time on risk tolerance. Your risk tolerance is a function of both your ability to tolerate risk and also your willingness to tolerate risk. Now, your ability to tolerate risk, well, that's a function of your goals for the portfolio and your time horizon. Say you're newly retired and you're using the portfolio to fund a large portion of your day-to-day living expenses. If so, you probably have a low ability to tolerate risk and shocks to your portfolio. Now, say you're 25 to 30 years old, you have 30 years until retirement. If so, you probably have a high ability to tolerate risk. You can probably withstand market volatility. Now, your willingness to tolerate risk, well, that's part of your psychological makeup. How do you feel when the market declines? How are you feeling right now, April 2025? We've seen some big market declines this year so far. Now, taken together, your ability to tolerate risk and your willingness to tolerate risk should match your portfolio so you can avoid any emotional mistakes. And a lot of the work that we do with our clients is making sure their portfolio and their financial plan matches their risk tolerance. Now, we understand investing isn't always about the numbers. Your family, your health, your goals, your values, those are some of the things that might be most important to you. And our clients hire us to do the heavy lifting for them so they can spend more time on what they value most. However, if you're going to stay invested, it's important to have some context as to historical market declines. Here's a slide from Vanguard. Vanguard constructed 11 portfolios ranging from the most conservative to the most aggressive. They use broad market indices according to a specific methodology. They provided the worst return, the average historical return, and the best return in 1 year. The data is from 1926 to 2022. Now, let's say you have a 60-40 portfolio. It's represented here as 40-60, but we mean 60% equities, 40% fixed income. Having that type of portfolio, you might get some understanding as to how much it might drop in one particular year by looking at the numbers here. Now, again, these numbers are historical. They're not forward-looking returns. And you should note, if you have concentrated positions, this data probably won't be relevant to you. Now, there's a couple of things you could consider. Say you want to reduce the risk of the portfolio, which you can simply shift your asset allocation. As you can see, the dispersions of returns go from high to low as your portfolio becomes more conservative. Now, there are also investments that have the potential to reduce risk. So if you want to discuss those investments or want me to do this analysis for you, please reach out to me. Happy to run the numbers for you. We can do it in literally a matter of minutes. Now, I'm very excited to wrap up the presentation with 6 actionable tips for volatile markets. There's a lot to cover here, so feel free to hit the rewind button. Feel free to reach out to me if you have any questions, and please reach out to your accountant if you have any specific tax-related questions. Tip number 1, monitor and/or reduce your concentration risk. A concentrated security is large in proportion to your overall portfolio. Be mindful of the risk of holding a concentrated position. You might want to consider contributing part of that position to a donor advised fund or using option strategies to hedge part or all of that risk. Tip number 2, build out tax-free income with municipal bond ladders. A municipal bond ladder is a portfolio of individual municipal bonds with staggered maturities designed to provide consistent tax-free income, exempt from federal taxes and possibly state taxes. Tip number 3, use tax strategies. 4 strategies to consider include tax loss harvesting, in which you're selling individual securities at a loss to offset realized capital gains. There's the Roth conversion, in which you're converting part of your traditional IRA to a Roth IRA. There's the backdoor Roth, in which you're making non-deductible contributions to an IRA, a traditional IRA, and then converting that to a Roth IRA. There's the mega backdoor Roth IRA strategy, in which you're making after-tax contributions to your 401k and then converting those contributions to a Roth IRA or a Roth 401k. Your plan must allow that. Now, Roth strategies are good ways to build up tax-free income in retirement. However, you must make sure you do it on a regular basis. Again, be mindful of the tax rules, and you may have to pay a tax on those conversions. Tip number 4, consider buffered exchange traded funds. A buffered exchange traded fund is simply an exchange traded fund linked to an index, such as the S&P 500, that typically offers some type of buffer on the downside, such as 10 to 15%, and still allows for upside appreciation, often to a cap, such as 10 or 15%. Those strategies tend to have higher fees, so please be mindful of that. Then consider alternative investments. If you're looking to invest in securities that are not publicly traded or not listed on the stock exchange, consider alternative investments such as private credit securities. These are private debt securities between a borrower and a non-bank entity. Consider private equity. These are investments in private companies. Consider private real estate, which are investments in private real estate, such as commercial real estate. Now, each of those strategies tend to be managed by a fund manager. They tend to have higher fees, higher risk, and are illiquid, so please be mindful of that. However, they're a good way to gain exposure to non-publicly traded securities. Finally, have a long-term financial plan. That plan should be meticulous. It should cover everything: your investing, your estate planning, your tax planning, your retirement planning. It should also consider annual Roth conversions that I mentioned earlier. You should consider education planning, insurance planning, anything in regards to your wealth. Now, if you want us to run a complimentary financial plan, please reach out to me, 917-590-0552. Happy to run one for you. Hope everyone enjoyed the presentation. Have a great day.